Hey everyone, welcome to this edition of Live Future and Stocks Trading on Bookmap. I hope everyone has had a good trading week so far. Got a little bit of a bounce back yesterday. We'll talk about the technicals and just a few, but first we're going to dive into some charts and take a look at what's going on. So, thanks for tuning in. Feel free to share this with your friends and colleagues and trading buddies and so forth as we look more into what's going on in these markets here. But before we do, there's a few things I have to go through, of course. So a little bit about me. You've probably watched this enough that I can kind of summarize. Essentially, I've been involved in the markets for about 18 years, starting with trading and going into investing. I like to look at technicals, the macro picture, and some of the other elements in the market, such as options, flow, positioning, sentiment. I'm really interested in finding pieces of the puzzle that fit together to create a theme. And so this is a little bit about me. My name's Markets and Mayhem. You could find me at Traderade.com for more trading-oriented content, Macrovisor for more longer-term trading and investing and big picture content, and then my YouTube at Mayhem4Markets, same as my Twitter handle. And if you'd like to get a huge discount on Bookmap, up to 40% off, visit our website, traderade.com/bookmap, and you can take advantage of that coupon by just scrolling down to the specials. And here is everyone's favorite part of my presentation where I quickly read through the disclaimer. General disclosure, all Bookmap Limited materials, information, and presentations are for educational purposes only, should not be used for specific investment advice or recommendations. Trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. So now that we've got through that, let's talk a little bit about the markets here. We have pretty decent bounce back from the lows in retail sentiment, which is just giving us a sense that perhaps people are getting a little bit more excited about opportunities in this market. Of course, we've had this sort of perpetual reflexive dip buying as being a consistent theme for some time, for really the better part of 14 years. It served people well, and so there's really no reason to believe that's going to stop now when we see this increasing amount of bullish survey participants here in AAII. So I think that that's one thing just to keep an eye on, that retail is likely, folks like us are likely to be buyers on the margin. But they're not alone. We've got managed money. They're also adding, in fact, pretty aggressively here. They've almost doubled the NAIM number from the lows to the present, going from about 35 to 66. That's a pretty big increase over the last 2 weeks. And interestingly, this contingent doesn't typically buy the dip, but this time they did. And we'll just have to get a better sense as to how that serves them with the price action in the days and weeks to come. But what's interesting about it to me is, often is the case that this contingent was actually buying into strength and selling into weakness. This is the first time I've seen them buying really into weakness. So maybe there's a different thought process that's going on after they had been burned quite a bit, kind of trying to go into the momentum and getting chopped up. We'll have to take a close look at how this progresses. And here is the CBOE equity put call ratio. I emphasize equity because we're not looking at the indices. We're not looking at the total. We're just looking at equities. Why? Well, because for me, it's a more distilled view of the data. I look at this because it tells me a little bit more about what market participants that aren't just hedging are thinking. And as of yesterday's reading, it really looks like they got very bullish again. You can see that the put call ratio dropped to 0.52. It was as high as 1.14 in September. So it's fallen by more than half. What does that tell you? It tells you that folks are getting more bullish on single stocks and ETFs, and that they're essentially transacting almost twice as many calls as they are puts. It doesn't necessarily mean buying, but most of the time it is buying to open. So that's something. We're not quite in FOMO territory. As you can see over the summer, that was like 0.34. We're not quite there yet, but we are at a point where there's excitement. There's some bullish optimism in the flows that we're seeing. Now, that's a little contrasted to what we see from the VIX versus the S&P. We have the S&P in blue, the VIX inverted in black, and we can see there's a decent inverse correlation between these two, which on this chart shows up as a positive correlation. Why is that important? Because volatility continues to suggest that perhaps we have some downside risk in equities. I think that's something to take into consideration, particularly given this next chart, and that is that earnings day moves over the last quarter were 4.1 times larger than what the average session was over the past 25 years. So volatility as a reaction to earnings is a theme, particularly as we get into this week where over 40% of S&P market cap are reporting. It's something to consider in the back of our minds that these reactions may be larger, and that could be a driver of broader market volatility because some of these components that are reporting are some of the largest components of the S&P and NASDAQ, like Microsoft, Google, Amazon, and Meta. And as we look underneath the surface of the New York Stock Exchange new highs versus new lows, we can see that we have new lows in excess of new highs by about 447. So underneath the surface, there is a bit of a breakdown happening in this market. It doesn't really affect our day-to-day trades as much as our swing trades, but it tells us that this sort of idea that there was going to be a broadening rally, this increasing breadth, and that this was going to turn into a healthier bull market may not necessarily be the case. There is some structural weakness here. Another interesting chart that I talked about in navigating the markets, which you can find on my YouTube for free this week, a special gift to all y'all out there. One of the charts showed that, bear markets typically from their low and 1 year forward, once you transition into a bull, are led by equal weight and small caps. But this time, that's not the case. This time, it's all been led by the market cap weighted index, whether we look at S&P or NASDAQ. And that's another sign that really there isn't that upside participation. So again, if you're of the mindset that you're swing trading and you're looking at this, it's not sending the most confidence, right? It's telling us that underneath the surface, there is some structural weakness. Now, let's take a look at the 2s to 10s yield curve. We are steepening out of a pretty deep inversion. Deepest inversion you can see on this chart over 2 decades. And that's important because, the inversion is where you get the warning sign, but the steepening into positivity, particularly if it's meaningfully positive, like over 50 bips, that's when you start to see warning signs for the economy. Of course, we all heard that Bill Ackman covered his bond short, made some good money. Everyone was making fun of him when he shorted, said, oh, this is the bottom of the bond market. At Macrovisor, we remained adamant that the highs and yields were not in. We still feel that way, by the way, even though Mr. Ackman is covered. But this is something that also further suggests the same case, that the long end probably has further to move higher. After all, if you're lending the government money for 30 years and you're getting a lower yield than what you would for 30 days, that suggests that there's some adjustment to that risk premium necessary. So let's take a look at some of these key options levels, and then we're going to start moving on to some more technical charts. This is the model that I built for Traderade that looks into the S&P 500's option chain on CBOE, analyzing about 212,000 data points across just about 10,000 options contracts. And then it derives some of these key levels based on concentrated positioning. So the most important level that we're really looking at here in the context of today is going to be this put wall at 4,200, and then above us, we've got this gamma level at 4,300. Those are kind of going to keep us sandwiched in, but as we open, that key level of 4,250 is likely to be a good pivot to look at, because if we can push higher, that would probably open us up for some decent upside, potentially 40 or 50 points more. On the other side, this put wall, which is also the vol trigger at 4,200, that's an area that buyers really need to aggressively defend. We saw yesterday, they were able to defend that level. We pushed below it, but we saw this sort of look below, fake out reversal, and pushed higher from there, only to give a lot of those gains back up into the close. So a bit of a seesaw, but overall, yesterday's price action was constructive for buyers, but we need to defend that level. Pushing below there, particularly on a closing basis, opens us up to more downside potential and more volatility. So that's going to do it for my slide deck. Now let's dive in to some of these technicals. Here we have on screen the S&P 500 E-mini futures contract. We can see that per RSI, we're starting to get a little, pardon me, a little bit oversold here, not much. And we're starting to see a little bit of perking back up. You can see RSI is, it's starting to move a little higher here. So momentum may be looking a little bit more favorable. We also had that look below reversal yesterday. You can see we went well below some of these prior lows that we can see. This line has been pretty good about delineating. If you pay close attention to the volume profile there, you can see something very certain. This has been an area that people have not wanted to transact. When we got this push below and buyers came in pretty aggressively and bought it back up and are continuing to do so today, that's worth noting. Okay, we got to pay attention to what price is telling us here. And what price is telling us is that buyers want to try to give it another go. So for the purposes of today, I'm going to be looking at 42.70 as my pivot. I think if we can push above there, build some volume, and have an opening range breakout to the upside that's a part of that process, that would get me more confident of taking a day trade to the long side in the S&P 500. But overall, if we look at this from a longer term perspective, zooming out from day-to-day trades, because remember, there's different time horizons. Very important to remember. Like if, we're talking about this on a longer time horizon, this looks terrible. This is a chart of lower highs and lower lows. It just made a bit of a lower low yesterday. Obviously, we'll need some confirmation on a closing basis to say that that definitely was the case. But this is a chart where the buyers on a longer term time horizon have a lot of work to do to convince the market that momentum is on their side. And that work, maybe it starts today, maybe it doesn't. But for the purposes of what I'm looking for in an intraday basis, above 42.70 with some volume being built to show acceptance would give me the confidence to say we've got some room to the upside here. And I think that that could even take us as high as 43.05, 43.09 if we get a good, decent push there. So that's one of the things we're going to be watching. We're going to be watching for that upside, that coalescence in options levels and technical levels. But let's move on to the NASDAQ. And once we get through all these charts, we're going to go into Bookmap and we're going to look at the liquidity way more zoomed in. So these are zoomed out charts for the purposes of showing some of the broader context of what's happening technically. Then we'll zoom in a little bit more and take a look at what's happening with the liquidity, both resting and active. So here's a chart of the NASDAQ 100 futures contract. You can compare this to QQQ. They're pretty darn similar, essentially tracking the same thing, although this instrument is trading about 23 hours a day and 5 days a week. Now, this is kind of similar to the S&P chart. We have this breakdown. This trend line goes back to October. You have this series of lower highs. We haven't quite made the lower low yet, though. So overall, it looks a little more constructive than the E-mini S&P chart. We did have this look below yesterday, this sort of fake look below, and then we're moving higher. So again, buyers stepping in aggressively, taking control. I think that's something to take into consideration within the context of this chart, even though on a long-term basis, it looks pretty terrible. We're below the 20-day moving average. We're below the point of control, but we have held this level. We had this look below fake out. We have RSI trending a bit higher. It's not as promising looking as S&P, but it does look like it wants to try to push higher. So momentum may be on the side of buyers for today. And if we can hold this level here, I believe we've got a chance to at least try to challenge this point of control. Whether that all plays out today, that's a whole different question altogether, as that's about really 300 points higher. So I'm a little ambivalent about that happening in the context of today, but on a weekly basis, if buyers are able to take control, getting back up to that point of control that takes us back about 6 months wouldn't be too surprising. That would also take us above the 20-day moving average, and if we could push above both, that would put buyers into serious control again. On the other side of it, if we do break below this current level that has been so adamantly defended for months, that's where I'd get more concerned about downside potential growing in the NASDAQ. So that's what we're really looking at there. Now let's take a look at our friend, the Russell 2000, which has just been, well, it's been a disaster, right? This is breaking to new lows on the year, okay? And we've had a little bit of a perking back up, but these small caps not showing any risk appetite in the context of what is supposed to be a new bull market is not a good sign. These are obviously more rate sensitive, as almost 40% of the Russell doesn't make any money, so they're much more reliant on debt. You also have a lot of regional banks in the small cap index, and they're languishing. Credit card delinquencies are surging, commercial real estate pressure is on the rise, and then their asset books, which are mostly long duration, U.S. sovereign duration, mortgage-backed securities, and otherwise, they're bleeding out as rates rise. So we can see some reasons here. Also, I know some folks aren't as into this stuff, the classic chart patterns, but as an older school trader, I am. And this is a classic head and shoulders. I mean, like you can see how it exactly played out. Left shoulder, head, right shoulder, and then you have that pretty clean breakdown that happened really just at the point of control, but you could take it a little bit above here. And it's pretty obvious, just classic chart pattern on screen, that this thing topped out. Okay, I think that's a concern. I think people should be a little concerned about what's happening in the Russell. Let me just zoom out to make the point. And I know this looks crazy. Give me a second here to kind of clean it up. But you can see it's a breakdown. Maybe we'll put it into the weekly chart for better context here. You can see we're really breaking down to new levels for 2023. We're now getting closer to some of these 2022 lows. So for the reluctant optimists here, maybe we start to see some support come in pretty soon. But overall, this has been chopping in a range for almost 2 years, these small caps. Let's take a look at the Boomer Index, the Dow Jones Industrial Average. And we'll zoom in to the daily. This is one that maybe it's trying to find its lows here, sort of like the NASDAQ. It hasn't had a really big breakdown in terms of the context of what we've had in October. It's just sort of been like a, hey, let's get back up to the point of control. We'll test this level up here. Bulls obviously couldn't make it. You can see there's a lot of resistance right up here. They got rejected. Now we're back down here. If you're a reluctant optimist and you're looking for a long, the Dow doesn't look terrible here from the sense of maybe some reversion back higher, sort of like the NASDAQ. If we can get a decent bid here and they defend this level, then the natural path is to go back to where people really like to transact, which is quite a bit higher. It's about 700 points higher. Might not be the worst trade ever as a swing. Wouldn't be doing it intraday, but you can see that your risk is pretty well defined. If you close below 33,000, it's probably time to get out of the way and even start to look for potential shorts. Now, I know everyone's been talking about bonds and notes and all that sort of stuff, and there's been a lot of prognostication that the worst is behind us and the best days are yet to come in these markets. I am still skeptical of that, and I'll tell you why. Because on this chart, and we can zoom it out to our heart's content here, there's nothing to like. This is just downward momentum, and it's been downward momentum since really early 2021. You can see how that's where it started. Remember, up here, the 10-year was trading with a yield of 0.5%. You remember those days, 0.5% 10-year? Maya, the times have changed. Just this morning, we were at 5%. We've dipped a little bit below that, but that's a 10-fold increase in the 10-year. That's huge in the course of, 3.5 years or so. That's a very big increase in the cost of servicing debt for the U.S. government, but also for all the debt around the world that keys off the 10-year yield. There's about $100 trillion of global debt that keys off the 10-year yield. A lot of it is dollar denominated, so a rising dollar also makes that debt harder to service, becomes more expensive. So as we see rates rise and the dollar rise as well, you do get some potential for a bit of a global margin call, so to speak, growing. The idea that rates have topped here and are just going to start to magically go lower might be a little bit optimistic. I'm still looking for rates on the long end to continue moving higher. I've yet to see anything that gives me a lot of hope that this move is over. So on a monthly basis, we could see this kind of move down on the 10-year futures to about 104. I think that's where we could probably see some more support if we look at historical trends of price. So for me, it's still a little early to be saying the worst is over. Let's look at the 30-year. Similar picture here, right? What's really striking, though, is that we're starting to look like we want to cross below this multi-decade point of control, which would be a pretty bad look. It's interesting. If you look at TLT, year to date, it's really crushed. But if you look at TLT from the date of its overall inception, which I think was like 2005, 2006, something like that, goes back quite a ways. It's only up from inception, notwithstanding dividend payouts, by about 3%. So think about that for a second, the amount of destruction that's happened. You can obviously see it on this chart. It's been a big round trip. What was the big driver of the upside here? What was the big driver of price upside and yield downside, right? It was QE. It was all this sort of intervention by the Fed. And now we have the opposite. Now we have QT. And you can see the impact is pretty darn alarmingly clear that liquidity is leaving this market. And it's interesting because, you know, you look at treasury flows and everyone seems to be a buyer in the US. You've got US retail and institutions buying hand over fist, but foreign buyers are stepping back. China is a net seller. Saudi is a net seller. Japan is significantly curtailed how much treasuries are buying. And of course, the Fed, which was the largest buyer at auctions, is now letting a lot of these maturities roll off their balance sheet per the caps that QT provides. Now let's take a look at our favorite shiny metal. That's gold. We're going to zoom into this one. This one's had an incredible run, and it's largely been gold doing what it does best, in my opinion. Gold is a hedge against uncertainty. It is a fear trade. It is very driven by psychology more than anything else, in my humble opinion. So this surge in gold that we've had and broken us out of this downtrend, it tells me one thing. I mean, first you see RSI starting to roll over. You see a bit of that up here. I think if there aren't additional terrible events that are happening globally, because that's the only way we contextualize what's really happening, that drive fear into this market, then gold has actually a lot more downside risk here. And the reason I say that is because positioning is starting to get a little lopsided. We're seeing a lot of excitement in this, and I've been in the gold market since 2005. I've been trading it for a long time. And one thing that I can say is that when you have these kinds of very quick, sharp moves upward, it's usually a very good place to take some profit, particularly if you don't know what the catalyst for continuation will be or if you're not certain about it. Because if we don't know what the catalyst for continuation will be and we're not certain about it, we've risen by, you know, over basically $200 from the lows, almost, right? Then what are we doing? We're gambling. So for me, I would be scaling out of this trade. I'm not necessarily looking for shorts in gold quite yet, but I wouldn't want to be super long here after such a big move that relies on worsening escalation to keep going. Let's take a look at crude oil futures here. This is still constructive. It's not great, but it's not gotten out of its longer term uptrend that it started over really the summer here. I like crude, but I would want to see a little more consolidation. And the biggest thing that I need to see in crude for my model is people getting away from their ultra mega long positioning. If we look at Brent and we look at the overall futures exposure via COT, it's very lopsided long. Similarly, if we go and we look at West Texas Intermediate crude, US crude, and we look at call skew, okay, so that's the distribution of premium in calls versus puts. There's a lot more skew towards calls. What is that telling us? That the positioning is a bit crowded. Okay, that gives us a sense that people are a little too excited about upside for crude, and ironically, that can cap that same upside. Now, we can get into some of the hedging dynamics as to why. If anyone has any questions as to why that might be the case, I'm happy to answer it. But if crude can start to base here, I like it. Otherwise, I'm looking for it at around 83.29. Either area, though, really, as long as it's staying above 80, but ideally 83.29, I'm constructive on its price action. I also think there's opportunities in the energy space. I also think that some of these stocks in energy could be worth looking into, as longs with crude consolidating here. There's this huge M&A going on in the space. You've got Exxon buying Pioneer. You've got Chevron's acquisition recently. There's a lot of activity that suggests to me that if you're able to find some of the midstream and smaller producers that are attractive buyout targets, that could also be an opportunity in this space to really generate some alpha. But overall, I like crude. I just don't want to necessarily get long here. When I was talking to our Traderade members, I was talking about getting long here and here on these kisses at the trend line that were defended, because for me, that's much better risk reward than what we're seeing currently. So we're going to look at one last chart on here, and then we're going to go into Bookmap. This is a chart of the US dollar index. We can see that it's testing that 20-day moving average from below. We can see that there's some key areas of price action here that it's sort of chopping along. I'm looking at this so far. Unless we break down, I'm looking at this as consolidation. Consolidation within the context of a broader uptrend. To me, it kind of looks like the pattern we saw in September here. So let's see if we have a kind of similar consolidation and then push higher. What does concern me is closing below the 20-day moving average and not being able to really get the muster to move above it in the context of RSI rolling over and us kind of being well above that 70% value range. So all of that tells me there are risks here. I don't want to be long the dollar currently, but I do want to watch it pretty adamantly for signs of continuation. So that's going to do it for the longer term charts. Now we're going to get into Bookmap. So give me 1 second to put that on screen. There we go. And we've got a couple different contracts we'll be tracking. We've got the S&P, NASDAQ, 10-year note futures, gold, and crude. So I brought gold into the fold today. And it's just because it's really become a pretty interesting part of the market to watch here. And what you see on the right column is an add-on that I've actually created. This is something that I coded that draws from the options model that I mentioned earlier in the presentation. And it analyzes those same S&P levels, but it articulates them within Bookmap. So this is an exclusive thing that we have for Traderade members, but I want to keep it going on this stream, showing you all what we're doing. Eventually, I hope to make it available on Bookmap's marketplace as well. And this morning, we've had a decent amount of earnings. We've had some overnight news that's probably worth processing. A lot of these global PMIs are coming in weaker than expected. Of course, we get U.S. PMIs, flash manufacturing, flash services this morning at 9:45 a.m., as well as the Richmond Manufacturing Index at 10 a.m. So those are things to kind of just keep in the back of our minds as we're watching price action. We know that some of these macro catalysts can have a pretty big impact. The mood right now, in my opinion, would be if flash manufacturing comes in materially stronger than expected. We go back into expansion over 50, and we see similar from services. I think that's going to cut short this reprieve in rates that we've had and give some upside push to rates and some downside to risk, particularly longer duration risk like the Russell and NASDAQ could come under pressure. On the other side of that, however, if manufacturing and services come in materially weaker than expected, I'd say 48 or lower, the expectations for both today around 49, that would tell me that we're likely to see a drop in rates and a boost in stocks. It sounds counterintuitive. Why the heck would economic data that suggests things are getting worse be good for stocks and be good for bonds? Well, mostly because the market is so hyper-focused on what the Fed does next that it's leading based on inference. So if you have weaker economic data, chances become that, hey, maybe the Fed becomes more accommodative earlier than what is priced in. That can give a pop to risk and a drop to rates. And on the other side of that, if you see stronger economic data than we are expecting, that could have the opposite effect. You could have rates rise and risk get pummeled a bit. This is something that I think is worth taking into consideration. That data is coming out in about, what is it going to be, about 25 minutes or so, 27 minutes. So we'll be watching that. I'll give you my thoughts on it as it comes out because I'll have about 15 minutes to discuss it before I have to get off. I'm here every Tuesday at 9 a.m. Eastern, so thank you everyone for tuning in. Appreciate it. You can find me on my own YouTube and Twitter at Mayhem4 Markets. That's Mayhem for Markets. So this morning, we're going to zoom out just a little bit. We can see the liquidity is thinning out a bit ahead of the open, which is interesting. We will be watching this closely after the opening bell, which is happening in less than a minute. Going into the NASDAQ, the opposite. You can see actually liquidity is building as we get closer to this opening bell here. So we'll be watching that as well. Everything can change as that bell rings. Ahead of the open, we've got just a little bit of a bid in bonds. You can see some iceberging here, buying into that weakness. Gold is, well, there's a decent amount of liquidity around gold. This is not a heavily traded contract. So to see about 100 contracts below, it's interesting. It's worth watching. And then finally, crude is weak. It's breaking below 85 here. So let's get back to the S&P here as we're at the opening bell. And also, I'm going to pop some of these charts on the screen as well occasionally during the broadcast. This is Motive Wave, where we look at the S&P over 4 different time frames. So just wanted to quickly pop that on screen just to show that so far we have this bit of a constructive opening. We are seeing some bidding happening. They're trying to build some volume. Let's see how that goes. We'll go back into the liquidity here. We do see from the open, that very minute the market opened, liquidity started to grow again in these resting bid and offers. Remember, we're looking at 4270 as a potential pivot and potentially looking at longs with a cross above there and some volume built to show acceptance. Now, as we're watching the opening, anyone out there has any questions or feedback or anything, let me know. If you're on the Discord for Bookmap, just tag me in and in the Mayhem channel and let me know what you're thinking. Otherwise, drop it in the YouTube chat, and I'm happy to share my thoughts and discuss what's on your mind. So obviously, S&P has a healthy bid. NASDAQ even more so. Look at that strength coming into the tech index this morning. A little bit of iceberg distribution here. You can see that selling. And now we're seeing a bit of a U-turn here from that constructive open. Let's take a look at the 10-year note futures. It is moving higher. This is such a liquid contract. You've got 3,400 on the offer, just casually sitting at 106, 150. And we're challenging VWAP here, potentially moving up to this point of control. We'll be watching that here. Gold, steady as she goes. Crude falling further. Wow, look at that. Down another 30 cents here just after the open. Everyone's content to hate on crude. Remember, we talked about it being a crowded position. It is a very crowded position. This is something that when we're looking at positioning dynamics, it's very important to understand when things get crowded to one side that it can limit how much price can move in that side's favor. Let's go back to the S&P. And as we're trading, I just saw about $450,000 of premium go to the USO ETF. That's the oil ETF with a strike price of 78 and an expiration of November 17th. So someone's buying the dip here in size. Someone also bought $138,000 of Meta 320 calls to expire on the 3rd of November. Those are the two big call premium flows I see this morning. I'm just going to add some of the premium flows to the commentary in case that helps you all. It certainly helps me getting a flavor for the market. And S&P is just continuing to kind of build volume around this point of control that's starting to move higher, which is good for the buyers. We have yesterday's most active call and most active put on screen. Once we get the data confirmed for today, we show that data on screen and replace yesterday's data. But the key levels that we're watching here that are based on this options model, they are updated every 2 minutes. And often they don't change too much unless there's a lot of position rotation underneath the surface. Let's go back to the NASDAQ here. Wow, look at that volatility. The NASDAQ is such a beta beast. So it actually had, it pushed to a new pre-market versus pre-market levels that we saw, pushed to a new high, right? And then it pushed to a new low. And now we're pushing back higher again in a range of about 150 points in a matter of minutes. Now, to add to the validity of this bid in tech, what I'd really like to see is notes catching a bid here. We see a little bit more, but I'd love to see that 10-year continue to push higher in price. I think that would be helpful for some of this long duration tech that's trying to catch a more strong bid. Going over to gold, it just continues to consolidate. And without a catalyst, this thing is looking a little bit heavy. And crude is trying to find its way here. It had a really difficult start to the day. The point of control is being dragged lower, putting sellers in favor. And now we're going to move back to the SPOOs here. They're getting a nice bid. We're pushing above 42.70. I do like the look of that. I think if we can build some acceptance up here, then this could be worth a long. So let's see how we do here. I'd really be looking at this. I like to give it at least 15 minutes or so for the opening range to be established. So that's what I'm looking for at the present. But if we do get that healthy bid above 42.70 and we build some decent volume there, I would still be interested in potentially taking a long. But see, we can see how that pivot level is getting some reaction. And that's exactly why I looked at it, because I figured this area price action could be an interesting place to get a better sense as to whether buyers have the conviction to make a more determined push. We do see liquidity building above and not so much below, so that is constructive for buyers. If trend agrees, liquidity building above typically can act like a magnet just like it can below if trend is moving in that direction. Got some more bullish call activity going on here. We've got $139,000 of premium in the IWM ETF to expire November 17th at the 170 strike. And then NVIDIA, you got about $200,000 of premium at the 465 strike for November 10th. So more bullish flow this morning than bearish. There is one bearish flow that came through for QQQ, 180,000 targeting 356 for the end of this. Actually, for today. Yeah, that's an actual 0 DTE they're trading there. And we are continuing to push above 42.70 on ES. We have liquidity thickening up here. You can see it's getting deeper red. That means that those positions that they want to take at those levels are growing. Let's look at the NASDAQ here. It's still chopping in a bit of a range, but overall is looking pretty constructive above the point of control in VWAP for now. And we have these 10-year futures that are just kind of chopping along, testing this VWAP level here. Again, for the NASDAQ, I'd love to see this better bid. I think it would help the techs gain some strength if we saw rates continue to push lower. I'm going to imagine gold, yeah, continuing to do what it does best, sort of chopping along, waiting for everyone to become complacent before it makes its next big move. That's what gold loves to do. And crude is starting to firm up a little bit here. That's a concern because if it does really catch a strong bid, that could put some upward pressure on rates again. So we'll go back full circle to the SPOOs here. We're building above that 42.70. We've got that acceptance starting to happen here. It's looking more constructive to consider taking a long, in my opinion. Of course, the big risk we have is in 7 minutes. We get key data, actually 6 minutes and 40 seconds now. We get that flash manufacturing and services PMI, which could throw a wrench in things. And the dollar is also firming up a bit here, up just about 0.5%. Interestingly, though, it is another day where commodities are leading. Coffee is up 1.24%. Orange juice is up 1.21%. So that's something to pay attention to. It's not the best sign to see such strength in these softs, in my opinion. It just pushes upward pressure into the sort of inflation dynamics, particularly as it concerns food. And we're still just kind of hovering around this 42.70 level, this pivot that I selected for today. I'm still wanting to see a more decisive break in either direction to tell me that we have an opportunity for momentum. And I think that the market is going to actually consolidate here until we get the data. I don't think we're going to get a big move until we get flash and services PMI. This is often what happens when there's a decent level of volatility catalyst just ahead. The market kind of consolidates, it gets to a key level, and then it waits for the data to make its big move. So for me, I'm going to be waiting for that data to get a better sense as to what the direction is going to be. And I like to look at rates as that data comes out because often they give us some valuable clues. We do see more liquidity building on the upside there. You see that new offer growing just above 42.82. I think that's about 42.83 on the offer at that 379. And it's interesting to see the liquidity building into an economic data event. Typically, you don't see that as much. Typically, it actually narrows a bit. So someone has some conviction that we're going to see some upside with PMI. Can see that with all the offers above us and the bids below thinning out. Let's take a look at the NASDAQ again as we approach this data. We're just about 3.5 minutes away. The NASDAQ's made a new high. This is looking pretty darn constructive. If you're looking at this on a 10-minute opening range, this would be a breakout. Let's look at rates here. Pretty flat on the 10-year. Got that bid up from the lows, but overall just sort of consolidating. Similar picture in gold. And crude is off its lows, but is still not looking so great today overall. Now, overnight, we got some news from China that maybe this time they might actually do some stimulus. She visited the People's Bank of China for the first time ever and basically tried to create the image that, oh, well, now we're taking this seriously just about a year after we've been saying that we're going to actually do something. I'm still skeptical. I think that there's a lot of smoke and mirrors over there, and I will believe it when I see it in terms of Chinese stimulus. Their market has fell to new lows for the year. There's a lot of problems that are happening over there. I know that they bounced a little bit overnight, but I would be cautious about getting bullish China. But I got that heads up from my partner's Breakfast Bites, which she releases on Macrovisor and Traderade every morning. It's a great heads up as to what's happened overnight, and it's free. So you can just check it out, get an idea of what's been happening and how it may impact the markets. It's good stuff. And I read it every morning to give myself a better heads up so I don't have to spend all this time looking around the world as to what news has happened. I just have it right there in front of me, and that helps me make better decisions as we navigate the market. So we can see here we're still playing around with that 4270 pivot level on ES, and we are, what, a minute 30 before the data. So again, consolidating around a key level before an important data release. No reason to get too aggressive in either direction until we see the data and the impact that it starts to have. We do see some more bullish options activity happening in. Triple Q's getting about $200,000 worth of positive flow for those 360s today. And just about 30 seconds until those core PMI data releases are coming out. And remember, 15 minutes after this, we get Richmond Manufacturing, but that's not quite as big of a deal. And that data is just about to hit the wires now. And yeah, the reaction so far does not seem particularly positive here. But anything can happen in that first moment after release. And manufacturing PMI comes in at 50 versus expectations of 49.5. So flat, not in contraction, not in expansion, but flat. And services PMI comes in a point higher than expectations at 50.9 versus 49.9. So that is high enough that it's going to put some pressure on this market, and we are seeing that. So I'd be more inclined to lean into the short side of this. The NASDAQ is really giving it back here. Let's see what's happening in rates. I'm going to guess that the 10-year, yeah, look at that. Exactly what we thought could happen. 10-year is re-rating lower in terms of price, higher in terms of rates. Not what this market wants to see. Gold probably under some pressure with rates rising. There you go. And here's crude oil also under a little bit of pressure. But let's go back to the SPOOs. They're not having a great day. They've dropped over 10 points since that data was released. Not looking great. So I'd be more inclined to look at this as a fade. If rates keep pushing higher, I don't see any reason to be constructive, because the mantra out there is that the economy is softening faster than expected, but the data is showing us something a little bit different. But again, let's watch how we process this. Let's give us just a few more minutes as we see liquidity come back in, see how the algos and larger trading houses are pushing the market around. And folks, while we're watching this, let me know if you have any questions. I've got just less than 14 minutes left on the stream. I want to thank everyone for tuning in. Really appreciate it. I see new faces and regulars, and it's awesome to have folks that are interested in the work that I'm sharing here. I hope it's helpful to your trading process and your overall education about financial markets. And you'll notice I don't just scalp every few points. I look really for dynamics that put reward in favor over risk by anywhere between 3 to 1 and higher. And I haven't seen a lot of that this morning. I think we're getting closer to the point that a fade makes sense. But I am a less active intraday trader, and I try to get the bigger moves. You know, that's really my focal point. So sometimes you're not going to see me take trades, and sometimes when you don't take a trade, it's actually a good thing. Over trading kills a lot of people. Your brokers love it. You know, you could put their kids through college, but for folks like us that are trying to build capital and preserve capital, less can be more. So I'm inclined to fade this as we approach the 10 o'clock hour and the Richmond Manufacturing Index. I think that we've got room to the downside. So I'm going to initiate a short position here, and I'm going to really be looking for most of this move, this positive move, to be retraced lower. I would stop out if we get back to that 42.70 level. I think that that's going to tell me that I'm wrong, because then we'll be above the point of control, we'll be above VWAP. But ultimately, I'm looking for this to basically get back into that key level of testing that we were at yesterday. So I can bring up TradingView and sort of show you what I'm thinking. And I know this data is a little bit delayed on TradingView. It's because I have real-time data everywhere else. But basically looking at 42.36 and below, and then all the way down to 42.13. These are the areas where I would be taking off my core and then my runners, if we're so lucky as to see that kind of downside momentum. I think it is a slightly higher risk trade because we have seen this washout. The Bank of America bear bull indicator is saying buy. Morgan Stanley's risk indicator is saying buy. These are, of course, longer time frame indicators. But on the shorter time horizons, it's still pretty neutral. So either side can really meaningfully take control. We're also past OPEX, so we sort of have this unclenching. That is to say that we were really chopping in a range in last week's, until we started to break down. But now we're outside of that. We've had a lot of that gamma roll off the chain, and it's likely that we see broader trading ranges. Adding to that, as I discussed earlier, the moves post earnings in these stocks have been 4.25 times what the average was for the last 25 years. Another catalyst for volatility as we have, 41% of S&P market cap reporting this week. And this is not like the move we saw last time. PMI came in hotter than expected, probably because it's not quite as hot as it was that time. It's not as big of a surprise to the market. Let's take a look around here. NASDAQ is really rolling over. It's now below the point of control and VWAP. Let's just zoom out a little bit here. We can see, a little bit of liquidity building below, but nothing to note. And the real key is S&P. I mean, S&P is a much more liquid trade than NASDAQ, so seeing what it's doing typically gives us a little bit more of a clue in terms of the liquidity situation, whereas NASDAQ is much more of a price mover, right? It just kind of whips all over the place. Part of that's probably because there isn't quite as much liquidity in its trade. Let's go over to our friends, the 10-year note, and we're retesting these lows. You can see the drop that happened on the data release. There was actually an iceberg buy into that, which I thought was kind of interesting. And then there's another iceberg buy happening here, helping to kind of stabilize prices. This is when institutions are putting in 1,000 contracts on the buy. Both of these are 1,000 contracts on the buy. That's not huge, okay, for a contract this big where you've casually got thousands of contracts sitting all over the book, but it's big enough to at least take notice if that pattern starts to build. Gold is off its lows, but still consolidating, just sort of been chopping this range for pretty much the entire morning session. And crude is trying to stabilize here. So mixed picture underneath the surface, but equity is just not looking so great overall. We do have more bearish activity in the options market as well. We've got some more triple Q puts coming in, the 356s for November 17th and about 313,000 of premium there. And then in the SPY, we've got the 419s and 420s. The 419s for 11.3, 171,000 in premium on those puts, and the 420s for this Friday, 150,000 in premium on those. Just about 7.5 minutes away from Richmond Manufacturing. This is not typically a big mover of markets, but still worth watching for any kind of large outliers in the data. That's really what the macro data overview for market participants is all about. It's really about large outliers and how the market's hedged going into those. If you see a large outlier the market's not well hedged for, you can get that outsized reaction potentially. See the NASDAQ and the S&P trying to stabilize here, as well as these 10-year note futures. Remember, the rates really are an important component of leading this market around. I know there's been a large divergence this year. I don't necessarily think that continues. I believe that rates are going to set the tone for risk appetite and equities in this final quarter of the year. And the shiny metal is starting to push higher here with that relief in rates. It has a bit of a bid. It's about $4 off its lows. And finally, with crude, just sort of chopping around here. We do have some liquidity building below and not quite as much above. Back to the SPOOs, just sort of chopping this range. I'm not liking this short as much as I did when I first saw the price action post-data release. Just because sellers don't seem to have any conviction here, at least of yet. And I've got about 6 minutes left on this. So if y'all have any questions, any feedback, let me know. If you're interested in getting a great discount on Bookmap, you can visit us at traderade.com/bookmap. Scroll down to the specials and get up to 40% off. And if you're interested in these options-driven indicators that we have, we can see now the most active put and most active call are on screen. This data is directly pulled from and processed, pulled from the CBOE and processed with my algorithm. and then fed into Bookmap so that we can see it. And these levels are dynamically translated from SPX into ES. So it's a pretty cool feature for Traderade Plus members on the Discord. The Bookmap stream is live basically 23 hours a day as markets are trading. No real decisiveness for either side here, though. We're above the point of control, which has been dragged lower by sellers, putting them in favor. But we're also testing this VWAP level from below. So kind of a neutral look so far. Looks like they're trying to build some volume, potentially make a push up here to this resting bid or resting offer above us. I don't see as much resting liquidity below us. I would like to see more of that to feel like I have a higher conviction for downside. Typically, when you see the larger parties coming in with bigger bids below than above, that can be another sign that maybe we're going to get that push. So far, it's a bit of a chop, but you have more of the liquidity above us right now by about 3,500 contracts, which is more than it was before. And that's another sign. Before it was 2.4 thousand contracts. Now it's 3.7 thousand contracts. Let's take a look at the NASI here. And it's actually building above here. It really hasn't had the same drag down of the point of control. It's retesting the VWAP. Let's see how it goes from here. Take a look at rates. Off their the prices off their lows, rates are off their highs. We do see some icebergs selling now, 1,000 contracts on the sell side recently. Again, that's not huge for a market that has such a huge order book. In this order book right now, there's 255,000 on the bid side and 295,000 on the offer side. So this is enormous when you compare it to the S&P, where the order book is actually not nearly as big, about 50,000 contracts across the ask and the bid. And then the NASDAQ, quite a bit smaller than that, 9,000 across both. So you can get a size of the relative book depth of all of these. It's quite a big difference. And when we look at S&P futures, it's also important to realize the vast majority of price impact is from market makers hedging delta in SPX options. About 70% of notional value traded among options, futures, and stocks is within the options market, with about 50% of it trading to expire in 6.5 hours or less. Got about 2 minutes left here on the stream. So again, thanks everyone for tuning in. We've got Richmond Manufacturing coming up as we end the stream here. It's not going to be a big mover in my opinion, but still worth watching. And we're getting closer to a point where I'm looking at closing out this short. We're building back above that 4270 pivot. And we see liquidity continuing to build above us and not below. So I'm going to close this out and take my lumps on it and look for another opportunity. We didn't get the follow through that I was hoping for. And because of that, I don't want to stay in the trade. In fact, the kind of relative resilience of buyers here is kind of impressive. We have to give it to them that they were able to kind of look past that data. The NASDAQ now pushing above VWAP as well. We do see some liquidity building above in excess of what is below by about, I think that's going to be about 300,000 contracts or so. And lots of liquidity building up here in ES above. This is a pretty key level. This gamma 4 level is an area that correlates to about 4250 on SPX. which was one of the levels we had talked about in the presentation as a key area to watch, very close to that pivot. So now that we're building up here, it actually is looking more like the long side could be favored. I think if we can take out that gamma level and that resting offer above us, then this would look like an opportunity to potentially trade this with upside in favor. So I want to thank everyone for tuning in. This is about the point where I need to wrap up the stream. Remember, we've got data coming out here in very shortly here. It actually just came out. Looks like Richmond Manufacturing just came out at 3 versus a forecast of 3. So sort of a nothing burger there. And we are pushing into this key gamma level. So again, for the long side trade, we're looking for this resting offer to be taken out to the upside, building some acceptance, and then we could make a further push higher here. So I hope this was helpful to everyone listening. Really appreciate you all tuning in. If you have any questions for me, let me know. And you can find me at Traderade.com for shorter term trading, options-driven tools, and other kinds of insights on the market and education, and macrovisor.com, where we look at macro and make it actionable for longer-term trades and investing. Thanks again for everyone that tuned in, and I'll catch you next week at Tuesday, 9 a.m.